So if you think what you've learned has been interesting, I can tell you that it's only the tip of the iceberg. It's less than 1% of all the things you're going to learn in the professional options trading course, because what you've learned so far has been simply buying and selling calls, buying and selling puts, and that's really the basics, the kindergarten stuff. And the full options trading course, you're going to learn 14 of the most powerful options trading strategies, where you're going to learn how to combine different combinations of calls and puts so that you can profit in any market condition with any kind of asset. So you're going to learn how to construct options to trade in the stock market with specific stocks like Amazon or Boeing, where you can trade ETFs, you can trade futures indices like the S&P 500 and NASDAQ, as well as futures commodities like oil and gold and natural gas. And we're also going to learn how to trade options on currency futures. For example, really recently has been the whole situation about Brexit. So Brexit is happening on the 29th of March, and I expect it to be extended or cancelled or second referendum. So I expect the pound to really shoot up post 29th of March. But it could go down. So in order to protect myself but have the chance of making a profit, I'm buying call options on the pound currency futures. So once you've learned options, you can again profit in any market condition with any kind of asset that presents an opportunity. So if you look at any kind of market, they go through different phases, right? So markets go through an uptrend phase or a bullish phase. And again, within a bullish phase, it could be strongly bullish or mildly bullish. And it goes on a bearish phase, which again could be strongly bearish or mildly bearish. And markets do go sideways as well, in consolidation patterns. So oftentimes if you just know how to buy stocks and ETFs, right, you can only profit in a directional way. So for example, market's going up, you buy and you hope that it's going up. If it goes down, you could always short a stock ETF, but there's always a danger when you short of unlimited risk if the stock gaps up against you. So with options, you're able to do all this with very limited risk. So for example, when the market is very, very bullish, you've learned so far you can buy a call option. So with a call option, what happens? You've got limited risk and unlimited return. And with a small amount of capital, you can control a huge amount of stock or index or ETF. So it's really cost effective. Now, if you are slightly bullish, you think the market's going to go up, but to a certain target price, we're going to teach you a technique in a basic course known as buying a call spread. So instead of just buying a call, we buy a call and we sell another call at the target price, at a higher strike price. So what that does is that it gives you not just limited risk like the call, but limited returns as well. You may be thinking, why would I want a limited return when I can get unlimited returns, right? Well, it's because you've learned that when you buy a call, it can be pretty expensive. Calls can, you have to pay the premium for the call. And as time goes by, what happens? Your call loses value because of time decay. So when you use a call spread, what happens? You buy a call, you have to pay premium. Now, you simultaneously sell another call at a higher strike price, at the target price. And by selling that call, what happens? You collect premium, right? Although it's going to be less premium than the long call. So the premium that you collect will use to finance or offset the cost of your original call. So by doing that, the cost of the trade is much lower. At the same time, by buying a call and selling a call at the same time, the time decay begins to get a net off. In other words, you're not affected by time decay as much anymore. So you're going to learn all these different techniques. Now, similarly, if the market's very bearish, is collapsing, you've learned that you can use a put. You can buy a put with, again, limited risk and almost unlimited return if the market goes all the way down. Okay? And if you're slightly bearish, you think it's going to go down, but to a target price, you can buy a put spread as well, which is again buying a put and selling another put at a lower strike price, which is where your target price is. So what that does again is that gives you that limited risk and limited return as well. But of course, the return will be a lot more than the risk. where you risk 1 to make 2 or 1 to make 1.5 or 1 to make 3. So again, by doing that, it lowers the cost of your original put, right? Because you sell another put at a lower strike price, you collect premium to finance your original put. So you'll learn all these wonderful strategies, okay? And of course, many times markets go sideways, whether it's a stock market, currency market, oil and gold. And many people, when the market goes sideways, it's very frustrating, right? Because they're not making money. But with options, you can make money when the market goes nowhere, right? So one technique you're going to learn in the basic course is to sell covered calls on stocks or ETFs, which means the stock is going sideways and you sell call options out of the money to collect premium. All right, so as long as the stock goes sideways, you're collecting the premium and you're getting almost free money. Yeah. And in the advanced course, you're going to learn non-directional strategies. We're going to learn how to profit again, whether the market goes sideways or within a tight range. One of the most powerful techniques you're going to learn in level 2 of the advanced course is the iron condor. All right, so the iron condor is a technique where there are now 4 legs to your strategy. So what you do is the market goes sideways. What you do is you sell a call, all right, above the market price where you collect premium. When you sell a call, you're getting premium. And then you buy another call to reinsure your first call. Because remember, when you sell an option, it's unlimited risk. So by buying another call, it limits your risk. It's kind of like selling insurance and buying reinsurance. Yeah. And then simultaneously, you sell a put below where the market is to collect premium again, and buy another put at a lower strike price to reinsure that first option. Now, I know it sounds a bit complicated, but once you've learned it step by step, it becomes really simple. So, in other words, you sell a call, buy another call. Sell a put, buy another put. And what that does is it creates a risk to return profile that looks like this over here. Like a condor, like a bird, right? Where when the stock price or the asset price remains within a range, within say $50 to $100, what happens? That's right, you make maximum profit. Of course, if the price goes outside the range, the price goes up too much or goes down too low, you end up losing money, right? But the beauty about options is that we use statistical analysis to calculate the exact probability of a winning trade. So there's no more of a guessing game that, I guess I've got an 80% chance of winning or 50% chance of winning. No, with the option statistics, we will calculate with mathematical precision the exact probability of a winning trade. So for example, in the advanced course, many of the non-directional strategies, we will set a win rate of 80 to 90%, and it's a statistical fact. So these are the powerful stuff you're going to learn in the entire options trading course. I look forward to sharing this knowledge with you and look forward to seeing you really grow your wealth and account with these strategies. Now you can see that currently, how's the market doing? The S&P 500, right? Well, it used to be trending very, very strongly on a clear uptrend, but of recent, in the last 1 or 2 months, you can see that it's been moving in a sideways fashion. All right. So in a sideways fashion, how do we make money using options? And again, I mentioned recently we use an iron condor strategy, where we sell a call, we buy a higher strike call, we sell a put, we buy a lower strike put. When you do that, you're creating a situation where, as long as the market goes sideways, you're making maximum profit, right? And we adjust the probability to 90% winning rate. By the event that it goes outside of the boundaries, we can repair the trade to a break even or just losing a bit sometimes, or even a winning trade. So let me show you an example. This is an account that I have, and again, I'm fortunate enough to have Mr. Bang Famvan, my options specialist, that helps me manage the account. Because as many of you know, I trade stocks, I trade Forex, and that's actually my main focus. I know all about options. I'm an options expert as well, but I don't manage my own account, right? It's Bang who helps me to do that, simply because I don't have the time, right? But this is one of the accounts, and as you can see, this was as of today. These are iron condors. You can see that we have created an iron condor on the euro currency. So again, you will learn how to trade options on currency futures as well, or spot currency. You can see this is a call, a put, and a call. Can you see that? So we call this an iron condor. So what we do is basically we sell a call, right, and then buy a call at a higher strike price, and then we sell a put and buy a put at a lower strike price, and we create an iron condor over here. Now GC is gold. These are gold futures. You can see that again. We create an iron condor on gold because again, gold's going sideways, euro's going sideways, right? And what else do we have on the trade? Let me see. Yeah, so the S&P 500 over here, you can see it's also going sideways, so we've got an iron condor on that as well. And we also trade individual stocks. So this is one of the stocks we are trading, which is TLRY, and we actually created also a condor on it. And as you can see, it made out of puts and calls and puts and calls and so on and so forth. All right, and even though the market's going sideways, we're making pretty good profits, right? You can see unrealized profit for the month so far is about 4,289. Just for you, yeah, about $4,000 in profit, right, currently on the account, right? So it's great, right? So allows you to generate profits in any market condition. Now, I've mentioned before that you can trade options on many securities, not just on stocks, but also ETFs, indexes, currencies, and futures, which are commodities like oil and gold. Now, personally, for Bang and myself, when we trade our portfolio, we actually prefer to trade options on indexes and commodity futures, all right, and currencies as well. We rarely trade on specific equities actually, and I'll tell you why in a while. So first of all, what's an index? So we can trade options on the index like the SPX, which is the S&P 500 index, the NDX, which is the NASDAQ index, and the Russell 2000 index. There's an index for these small cap stocks in the market. So we prefer to trade the index rather than individual stocks. And the reason is because for individual companies, the companies could announce earnings or some bad news that causes the stock to gap up or gap down, screwing up our trade. But for indexes, you are basically trading a collection of many companies, so you don't have to worry about earnings announcements. So that's why we prefer to trade options on indexes as far as possible. So indexes tend to be the most liquid securities with very tight bid and ask spreads. And we don't have to worry about dividend as well. Again, when a stock announces dividend, it could also affect the stock price that we don't really care for. Yeah. The other thing is that indexes tend to be European type options. There are actually two main kind of options: American options and European options. So for European options, you can only exercise your option on the expiration date. But for American options, you can exercise your options anytime before the expiration date. And again, as option traders, we don't like to exercise our options, or we don't like people to exercise the options that we sell, right? So that's the advantage of, again, trading the index. It is a European type where people can't exercise the options early. And as I mentioned before, for indexes, there's no concern about earnings or any announcements like the CEO died, or there's some kind of M&A activity, mergers and acquisitions. Indexes also tend to have higher price tags, and so they reduce the number of contracts we need to trade, hence we pay less commissions. So that's the advantage of trading on index options, or options on index, so to speak. We also like to trade options on commodity futures. So for example, whenever you see slash, like this is slash, like backslash, it's a futures, it's a future security, right? So slash CL, these are oil futures. Slash GC, these are gold futures. And NG is natural gas. and these are bond futures. So we trade options on these futures. Again, because they are very, very liquid and very, very good premiums, especially heading towards key events, especially when you're selling the options to collect premium, you get very good premium out of it. Okay. Do be careful if you're trading using interactive brokers. They do charge extra fees on oil exposure. All right, but for think or swim, they don't charge you these extra fees. You can also trade options on volatility instruments like the VIX or the UVXY or the SVXY. But currently, I do not recommend that, right? We don't trade on these because they're really risky. So I'll stay away from that, right? Now, currency options are also really great to trade. So for example, /6E and /6A. So this is the euro, and then you have got the pound, you have got the Swiss franc, and you can trade options on those as well. And they're very similar to the index in terms of the way they behave. Now, finally, yes, we also trade on equity options, stock options, but we tend to focus more on large cap stocks, which are stocks in the S&P 500, your Apples, your Google, your Facebook, your Microsoft, your JP Morgans, and your Goldman Sachs. We do not trade options on penny stocks or low price stocks. So again, in the strategy section, we'll be sharing with you for this particular strategy, what's the best thing to trade it on, right? For example, for a certain strategy known as Iron Condor, for that strategy, we tend to trade it on oil as well as the index. And right, so but for another strategy, we trade it more on equity. So it really depends on the strategy. So hold on to that. All right, so before we move on to the strategy section, you have to know roughly when you trade an option, how big is a contract. So I've mentioned before that one contract equals to 100 shares, right? Now that applies to stocks, ETFs, and indexes like the S&P 500 or the NASDAQ. Now, if you're trading futures like crude oil, which is one of the favorite things that we trade, one contract equals to 1,000 barrels of crude oil. Don't worry, they won't actually deliver the oil to your house. Okay. Next, natural gas, one contract is 10,000 MMBTUs. You learn more about that later on. For gold, one contract would be 100 ounces. For S&P futures, so again, you can trade the S&P 500 itself or the futures contract, which is known as the E-minis, right? And for that one contract will be 50 futures. And for currencies like 6E, that's euro, 6A, that's Aussie dollar, 6B, that's British pound, ZB, that's US dollar. You can see that for one contract, that's 125,000 euros, 100,000 Aussies, 62,500 pounds, and 1,000 US dollars. So one contract size is pretty different for different instruments. So again, as we go into the strategy section, we will repeat that. So no worries about that. So congratulations for completing lesson 1. You now know the basics of options. So in lesson 2, you'll be meeting Bang, who is the options specialist and the best options trader I know. Although his name is spelled B-A-N-G, don't call him Bang, call him Bang, right? So he'll be running through with you lesson 2, how to set up your charting platform and how to use all the different trading tools. So how do you create a watch list? How do you read and analyze an option chain? How do you analyze risk-reward ratios? How to use probability analysis to select high probability trades? And how do you place and modify orders? So that's in lesson 2. In lesson 3, you'll be learning the most basic and the most aggressive strategy for directional trading. And that's basically buying a call and buying a put. Now you may think, hey, didn't I just learn that? No, you didn't. We're going to be going into in depth in lesson 3 on when is the best time to buy a call. And we normally do that when volatility is low, when we're very aggressive and bullish on a stock, on a currency, on a commodity. At the same time, when do we buy a put? And again, what are the specific steps to buy a put? How do we execute it in the best environment? That's in lesson 3, buying calls and buying puts. In lesson 4, you'll be learning about how to generate extra income with a stock investment portfolio by selling covered calls. So this is a very, very common strategy used by fund managers that manage millions or hundreds of millions of dollars. And how do they generate an additional 15 to 20 to 30% in income on top of their dividends? By selling covered calls. So again, you'll be learning the strategy of how to do that profitably and generate a good stream of income for yourself. In lesson 5, you'll be learning how to hedge your investment portfolio with protective puts. So again, this is where you learn how to buy insurance to insure your investment portfolio during a short-term downtrend or bear market. So how do you calculate the perfect hedge? By counting deltas and profitable entry and exit execution rules. In lesson 6, you'll be learning Warren Buffett's favorite strategy, which is how do you buy your favorite stocks at an undervalued price or even sometimes for free. So we call this selling cash secured puts. So I've mentioned it before where you want to buy Coca-Cola at $60, or rather Coke's now at $60 and you think, hey, I want to buy it at $50. What do? Well, you could wait for it to go to 50 or you could sell puts at $50. So by selling puts, you're collecting premium. Remember that. So if the stock price never goes down, it keeps going up. What happens? You're collecting premiums. And the options you sell expire worthless and you're generating income for yourself while you're waiting for the price to come down. Now, if the price of Coke does go down to $50, by selling the puts, you're obligated to buy the shares at $50, which is what you want to do anyway. So this is a win-win situation, and it's a very powerful technique used by great investors. That's selling cash secured puts. In lesson 7 and lesson 8, you'll be learning a strategy which is a directional strategy. So in lesson 7, it's a bullish strategy. When you think a stock's going to go up, or currency is going to go up, and you want to, instead of buying a call, which is quite expensive, how do you buy a call, right? And at the same time finance that call by selling another call at a higher strike price. So by doing that, by selling a call at a higher strike price, you're collecting premium that finances the call that you bought. So that lowers your cost of going long. Now, it does cap your upside. As you can see, instead of having unlimited return, you now have a limited return, but that's fine because you have a target price that you want to get out of and you want to make money from. So again, limited risk, limited return, but very low cost of going long. In lesson 8, you're going to learn the bearish strategy to that, which is known as buying vertical put spreads. The first one was buying vertical call spreads. So again, this is a strategy where you want to go short, you're bearish on the market, but you don't want to just buy a put, which again can be expensive. You want to buy a put and sell another put at a lower strike price. By selling that put, you're collecting premium to finance the put that you originally sold. So that lowers your cost again. So it's a low cost strategy to get bearish and short the market. So that's in lesson 8. So these are directional strategies. And in the bonus lesson, you'll be learning all about technical analysis. So again, the best way to trade options is when you know the highest probability of price movement. Is the market on an uptrend? Is it on a downtrend? Or is it going sideways? And on an uptrend, you know the best time to go long. On a downtrend, the best time to go short. We'll be covering all that in this lesson on technical analysis, how to identify trends, support and resistance, moving averages, indicators, and candlestick patterns. So it's a power-packed course. I hope you enjoy it. And if you ever have any questions, send an email to support@piranhaprofits.com, and myself and Mr. Bang Pham Van will answer your questions and ensure that you are successful as an options trader in this basics options trading course.